So I'm really excited for our second show today. Have a really good friend of mine, Jeff Thibodeau, in the house today to talk to us a little bit about investments, real estate investments, and specifically how he's built a huge portfolio in just a little over 2 years. So I've known Jeff for, probably 8 or 10 years now. We first met, Jeff was my coach through Tom Ferry. So Jeff helped me develop my business in some of the early years and was always a great inspiration through coaching and has continued to be a great friend since. A lot of changes over his career, ran a team like me at one point and then broke off into the brokerage space, started Redline in Brantford, has since sold that and has now taken an entirely different path and has started an investment group assembling rental properties and also doing some flipping. So we wanted to dive into that today, but I thought maybe we could start off, Jeff, with you just kind of taking us through your journey and what led you to this point in that shift in what you're focused on.
Yeah, thanks for having me on, Mike. I appreciate the intro and looking forward to talking today. As I've had to trace back this kind of like investor origin story for myself before. And when I uncovered it, I actually realized I was interested in this stuff as a teenager. As I was talking with my mom, I used to go and get the books, Rich Dad, Poor Dad, or be up late night watching one of those seminars with the guy on the yacht telling you could just buy a house and do this. And of course, I didn't have any money back then and my parents weren't wealthy. So investing in real estate wasn't an option. It was just an educational thing. But then I got pulled back into the industry about 12 or 13 years ago, I guess, deciding to get my license. That was my first venture into it. And I started with trading. And then just through that, again, same through being coached up and deciding I want more and more and more, you end up growing a team and a brokerage and all that. And then I guess at some point it was a realization that, hey, we've gotten away from this original vision. And myself and my partner that owned the brokerage with me kind of looked at each other and said, hey, we really know what we're doing here. Why don't we start making ourselves rich and start making, and not stop, but instead of making our clients rich every day, right? If we're out here saying this is an amazing deal, why aren't we just buying it? And it shifted the focus for us. And we partnered up with his cousin, second cousin, first cousin, doesn't matter, who's not a realtor. And then also Julie, who who was an administrator at the time from my company, but also has gotten her license since. So the four of us, with similar goals and similar timelines to retirement and things like that, decided to push our efforts together instead of each doing it ourselves. And that was the birth of this investing team here. And we really well timed. I'll say we didn't know that this market was about to slam upon us, but we timed it really well that we got in and started buying up stuff right before this latest round of appreciation. So we've been lucky in that way.
Yeah. So we were talking the other day, just prepping for our talk today. Am I correct to say you've got 27 rental properties right now? Is that
27 doors? Yeah. Some of them are fourplexes and stuff, right? So not 27 addresses. And in our holdings portfolio, we have probably another 20-ish assets that are in some phase of development that aren't currently being rented or whatever. So we 27, 30 properties, 27 active rental doors, things from vacation properties all the way up to just standard fourplexes. But we'll also be working on things from small cosmetic flips to full on, we're building a 4-unit home from scratch right now, like a semi with rental suites. So and we bought 100 acres to hopefully develop into a subdivision at some day. So we're trying to do and try everything. Yep. But doing it both on being like the traditional buy and hold landlord style of the business and also the development or what you'd call flipping or whatever, trying to actively do both sides of the investment business.
Okay. So I've got a few questions for you today, but I think one of the big ones that I'm most interested in, and I think most of the people that are going to tune in is how did you get started with this from a financial standpoint? I'm going to go out on a limb and say that you weren't a billionaire when you started this, so you had to rely on some sort of leverage to start assembling these. So what did that look like for you, Jeff?
I think it's important for people to understand that just like stock investing or any other type of investing activity, there's different strategies and different styles of portfolio. And what a lot of people teach in real estate investing is like kind of an already retirement portfolio. They're focused on cash flow, right? And they're saying if you already made your money over here at your job or something, why don't you go put it into a house over here? And that's pretty smart. But you have a great question, which is what if you don't have hundreds of thousands of dollars, or you didn't just cash out from your company or something? And we actually started our company, academically from zero, because we started a numbered company, and we formed it ourselves, just a little corporation, and we didn't put a dollar of our own capital into it. And so if we could do that, anybody can. Now the how, we did it a bunch of ways. The one way that's most accessible to all of us is if you already own a residence. Obviously those residences have gone up significantly in the last few years. So using some of our personal home equity, I wouldn't recommend this for everyone, but extending our credit cards in the early days. And then also in your first level of network, I guess the who there's a lot of people in that space that would want to invest in real estate, but don't have the time to get the hours and hours and years of education to do a successful deal. So it's finding capital partners too that want to be invested in real estate and trust you to take care of all the details and go ahead and split the profits that way. So a combination of all three, accessing your home equity, pulling up some leverage or debt the ways you can, investing it wisely, not in a risky way, and also finding partners who do have the capital but don't have the effort that needed to go into a real estate investment. And I think those three methods are available to everyone. We had an advantage of being experienced realtors and owning a brokerage, so we had a lot of trust early. Like I didn't have to convince a lot of people. I knew what I was doing. But if you don't have that, then you're going to have to be twice as good, 10 times as good at doing the research, putting a presentation together to say this is why this is a sure bet. And then you'd be surprised how quickly someone would gladly hand you some money. If you can get someone a 20, 30% or better return on their capital, they're not getting that anywhere else. And the other thing is a lot of people like to invest in things that are tangible. So, the average Joe and your friends and family, for them to buy RSPs and stocks, it's very boring. But to say I'm partnered on flipping that house, that's fun to talk about, even if they're not physically going to the house. So I think it was a lot easier than we thought to find people that wanted to do business with us and give us their capital. So from the major banks on down, money is the biggest challenge of real estate investing for sure. You got to get your money figured out.
So take us through the process, Jeff. So you're out there scouring the market for good investment opportunities all the time. Let's take everybody through what you're actually looking for. And then once you found it, what does that look like? Securing it, getting it ready for rental, getting it ready for flip, or even making that decision as to whether or not it becomes part of the portfolio, or you flip it and take your money out and move on to the next one. That's a lot of that's a lot of question to unpack there.
Yeah, but I'm glad you put it all together, because it really all comes with one central answer, which is we're not out chasing opportunities, right? This is actually the first mistake we learned really early on, is we bought 3 houses up really quick, right as our partnership had formed. Actually, kind of before it had formed, one of our partners had bought them, and then we decided, hey, let's join up. So we got dumped into 3 projects right at once. And if you're smart and if you're resourceful, it can feel good to try to engineer a half-assed project into success. You know what I mean? You can feel like you did a win there. But that same effort, we realized, should have been put into finding winners, not making winners. Right. So at that stage, after doing those first 3 projects, we really had to sit down as a team and said, we got to get clear on what the goal is with each of these projects, so that we can go and just start finding the exact match, instead of just finding, oh, this thing's for sale. Can I make it work? I don't know. So reverse engineering the whole process is step 1. And deciding what's a perfect investment for Mike is different than a perfect investment for Jeff, and it's different than my parents today. If all 3 of us sat at a table, 3 different potential properties to add or strategies for our portfolio. And that's a big one, because I think we say, oh, I'm investing in real estate, but that's just like saying I'm investing in the stock market. Like, what are you doing, right? What stocks, how's your portfolio? So I usually sit with people now as one of the services I offer to kind of help them figure this out, instead of just, oh, should we buy that house? No, let's stop. Let's pump the brakes right now. Where are you trying to go? When are you trying to retire? When do you want to sell these properties? Does cash flow matter? We go through a lot of questions. Now, for our team, we operate on a few simple principles. Number one is I'm looking for something called instant equity, right? And this is something that, if you are in the real estate business, you're going to have a little bit better chance of identifying this. But it's like, Mike, if you saw a house come on the MLS today, just by looking at it, you go, ooh, that's underpriced, right? Like, and then you would confirm that with a showing. And then if it was true, you might just make them a full price offer and grab that house. So instant equity is our first safety net in de-risking of investing, because it means that if done right, I should be able to close. And if I, for whatever reason, need to pivot the very next day and put that on the market and sell it, extract all those costs, I should still at least be break even, if not better. And so if I can find a house like that, I've almost taken all immediate risk out of the project. And I've also got most of my gain the day I just closed, right? Because that day, that property went up. Now that's hard to find today because the market's so competitive, right? There's lots of buyers, but markets always shift. So when the market's slower, it's a lot easier to find those. But it still can happen today when someone drastically underprices their home and the bidding war doesn't even bring it back up to the level of true market value. So that's a key skill. The second thing is we like to buy properties that we can force the appreciation on. So that means that I'm not just waiting for the market, but I'm going to physically improve the property somehow in an ROI positive way. So if I'm going to spend $1,000, I want to make $2,000, right? A 2-time return on any construction dollar. And again, I'm mapping that out before I make the offer. We're not going to get into a project and then cross our fingers and hope the budget's going to work out. So knowing your properties and having, the more you do, the more you keep good notes on all your construction, and you start to learn what bathrooms cost, what flooring costs, and you get good at kind of vetting out the potential projects. And then also you need to be good at predicting if you are going to sell it or refinance it, you got to be able to pre-predict what value you're going to get it to. If you're wrong there, well, good work. Your math made sense, but then you come to the day to sell it, you don't get your number, or you go to the bank and refinance it, you don't get your number. So these really 3 key skills for me, when I realized that this game of real estate investing is mostly just math, and then add 10% real estate skills in your local market to it. But it's mostly just finding a mathematical winner before you ever buy it. Once you've bought a winner, it's just a ball rolling down a hill at that point, right? You just have to make sure the project doesn't go off its rails, but momentum's taking over because you've already bought something that's, you bought it undervalued. You're going to force the appreciation. It's in a nice market that's appreciating too, and you got good financing on it. I mean, what's really going to go wrong?
Yeah. So it's really a multi-dimensional approach to looking at the investment. I think traditionally, people looked at capitalization rate, right? And they wanted a certain return on their investment, from a cash flow basis.
Yeah.
And at least I can say in our market, having boots on the ground here, that we're seeing people buy rental properties like multiplexes or even single family homes to rent, and they're selling at prices that seem to ignore that traditional thinking as I think if I had someone reach out to me historically, it was an investor saying, well, I want to buy a duplex and I don't want to look at anything that has less than 6% capitalization rate, right? But you're saying that's one piece of it, but probably not even not even at the top of what you're looking for, right?
No, we could talk about cap rates for a while, but they're a useful data point to compare properties to each other, but not to you, if that makes sense, right? Because a capitalization rate does not consider financing costs. So capitalization rates assume that you're buying in all cash, and most people aren't. And I could, even if you have the cash, I would advise you not to, right? I wouldn't buy one house with it. I would split it up and put 20% down on 4 to 5 houses and get them leveraged. So the cap rates are really kind of a more academic measure from industrial and commercial real estate. Applied to multifamily residential, it can help you compare 2 properties. But I think if anyone came to me at this stage or any stage saying it needs to have X cap rate, I would want to have a deeper discussion as to why. What are you basing that off of? Because even a 6% cap rate to me is not that exciting. You can get 6% in the stock market or whatever. What's exciting about real estate is the ability to leverage it, right, and improve it. So again, the cap rates I find are for people that maybe are at the end of their investing career. They don't want a lot of risk, so they're buying on low leverage and they're expecting almost a dividend check from their property. If you're younger and you're trying to grow your property, the cash flow really, if we think about it, the cash flow is really just a gift that allows us to leverage the property. We don't really care about it because right now you and I, we have jobs, right? And most of your clients have day jobs. They're not full-time real estate investors. So to get an extra $200 a month cash flow, sure, it's nice, but what are you getting? A dinner out extra a month? When you look at what you're getting for the property growing every year and your mortgage being paid down, those returns far eclipse the cash flow needs. So for those of us building a portfolio, to not really worry about cash flow or even accept a small amount of negative cash flow, because if we really think about it, every other investment you make in your life is a negative cash flowing investment. If you're buying stocks, that's negative. You're putting money out. Your own personal house is a negative cash flowing investment. You pay for it every month. So what other investments do you make that pay you back? Well, they're only really, again, these wealthy investors who maybe you bought a whole ton of dividend paying stocks, right? And now you're getting your yield. So to me, it's a cap rates are a very basic thing, and it prevents people from doing creative things because we're just looking for turnkey stuff, already rented, hands off, put my money in, get my rents back. It's the very basic form of real estate investing, kind of treating it like a mutual fund. For what we're doing right now, Mike, and what we've seen happen over the last, you're up in Thornbury, the appreciation on these houses would have far exceeded if you never even rented them. If you just went total negative cash flow on them, and my personal cottage is an example of this. I never rented, yet it still has been an incredible investment, even though I have to pay a mortgage every month. But that total sum of all the mortgage payments, all the maintenance, all the taxes is a fraction of what it's going up every year. Well, even if I never visit it. So that was one of the first investments that made me really realize what was possible. And I didn't buy that property as an investment. I bought it for fun. But then watching what happened to it, well, it's just sitting there empty. I was like, oh my God, I need more of these.
Yeah, I think if we look at it from our market's perspective here, I think that's been one of the fundamental shifts here, right? Is that investment in a recreational property around Blue Mountain or on the water was typically an expense, right? It's, you've hit a certain amount of wealth, you can afford your cottage, but it was never looked at as really an investment vehicle. And that's, I think, is part of the reason why we have such low inventory now, is that all these people in Toronto are sitting there thinking, well, hey, I can have a cottage and it makes money for me, even if I'm not renting it, right?
So it's making your balance sheet go up, and then the modernization of short-term rentals, right? Of course, you could always have rented your property before, but it's so easy now to just throw it up on Airbnb or whatever, right? And so you can turn what used to be like these backwoods cabins that you used to go up to once a summer, and now you can turn these into profitable investments. And also the fact that in our parents' generation, values outside of the GTA didn't tend to appreciate that much, right? But now the entire province, because remote working, because there's more people, so yeah, I think that looking at that and really running a projection, one of the favorite things I do when I sit down with someone who isn't a real estate investor yet is I just show them the power of one more house, right? I said, if we just today, I show them a path, stay on your current path, keep paying your mortgage down, or let me just convert some of that equity into one property and let's run those two houses down for 10 years. And just usually showing somebody that, it tips them over the edge, because it's millions of dollars difference typically in 10 years time, because now you have two assets. So I think that's the big thing. If you're young and you've got 10 plus year window ahead of you, the main thing we got to be thinking about is, how do I have, like on a Monopoly board, right? How do I have more of those little houses? If I only have one right now, or maybe one plus a vacation home, or one plus a rental, can I get to 3? Can I get to 4? And the younger I can do that, the more all those assets are going to grow together. And later in life, I can sell off 1 or 2 and convert it to higher cash flow later. But for now, the appreciation and the leverage are the two biggest levers, that we can pull.
So let's unpack the leverage thing a little bit. You posted something to your social channel the other day comparing, $100,000 into the stock market versus $100,000 used as leverage to buy your next rental property. So just so people kind of understand the difference.
Yeah, and I even was fair to say, look, the real estate market returns have almost been similar to the S&P 500. Actually, the S&P 500 outperformed it by about a point over the last 10 years. So you could have had two choices if we think about it. Is you could have taken that money and went and bought a house for cash and had break-even rent, we'll call it, right? Just to make the equation simple. Or so forget the stock market, just the difference between buying a house for cash or buying a house for leverage, which I had to really, the reason I went over this exercise is because we were starting to make money and we needed less borrowed capital. So I ran an academic exercise for our own team that said, what if we just did a complete flip with our own money? We didn't have a partner. We didn't go to the bank. We hate interest costs. And as flippers, we're paying 8 to 12% interest on our loans, right? They're not A+ bank loans. But even running the scenario like that, it was like, no, you should always get the loan, because now with the loan, I can do 2 or 3 flips at the same time instead of one. And that's the power. So the same principle applies. If you bought a house for all cash, you got to put 100% of it down. Or the bank will let you only put 20% down. So theoretically, you could buy 5 houses with that same money that you just bought one house with. And now if we think we got 5 assets growing, the average house just went up like 100,000 or more in a year. So you just went up 500,000. And that doesn't happen if you only have the one house. And this is a crazy thing. This might be too deep for this conversation, but general economics, once I've read this and really understood it, okay, assets inflate, right? Debts don't. Now just let that one sit there for everybody and let that noodle around in your head. We're in a high inflationary environment across the entire market right now, not only the real estate market, but everything. So everything's going up in value: commodities, stocks, bonds, cryptocurrency, real estate. What's not going up in value? How much you owe on your mortgage. It doesn't inflate. It actually goes down because currency is devaluing. So in these high inflationary times, being as leveraged as you're comfortable is the smart financial move. It's not always. In our parents' generation, the market was opposite. It was high interest, low appreciation, right? So you got to be, but in this market where money is ridiculously cheap and every asset other than cash is rising, I'm not your financial planner, but being highly leveraged right now is an advantageous position to your comfort level, right?
So let's go back to actually sourcing these types of investment properties. If we had to pick, the top 3 characteristics of a property that you're looking for, what would those be? Like things like location, condition, as an example.
Right. So we're kind of, if you think about, I used an analogy like bowling, right? If you've ever gone bowling and then you take the kids and they put those bumpers on the side, that's what we want to do. We want to define what those bumpers are so that we don't throw a gutter ball, right? And most people don't even think about that. They just they don't even know which way the pins are, right? They're just like, oh, this house down the street for me, the old lady just passed away. I think we can get it for a deal. Let's go. And that's again back to that wrong way of thinking where you're going forward. So if I'm coming from the reverse and say my portfolio says, hey, it'd be really nice to add 2 more rental units to our portfolio. Okay, what's the best way to do that? The ultimate best way is to buy something and build them ourselves, because we want to add the value to our portfolio. So again, back to the strategies. Number 1, I'm looking for instant equity, right? If I'm not looking to overpay for anything on the buy side, if I do, I've just added so much risk to this deal, it's unnecessary, right? So first of all, once I've identified neighborhood, right, or area, price point, you're getting good ranges. After that, the first qualification is, if I bought this today, can I sell it tomorrow and not lose my shirt? If something goes wrong with my life, right, my finances, I need to sell. So that's the first one. Second one is, if you're going for appreciation, we want markets that still have a runway ahead of them, not have seen their best days, right? Now, we're lucky right now, all of Canadian real estate is inflating. That doesn't always happen, right? So in a general calm market, you're looking for a city that has a future, not a past. So you're looking for employment to be increasing, growth, new housing development, more people moving to the city, prices rising, proximity to larger centers is nice, new or upcoming vacation markets. Obviously, the vacation market closer to Toronto is better. Prices up on the Bruce Peninsula, where I have my cottage, are lower than Thornbury. And then over to Muskoka, a more established area, is more expensive, right? And Thornbury is probably trying to catch up. to Muskoka pricing. So all of these things in mind. But I'll tell you one thing I like the best, because we have bought properties out of province and stuff, and it's not as fun, even though there's good deals. So still, I think backyard investing is important because it's good to be able to know that maybe your city isn't the A+ city on all these marks, but you know your city better. So it's really, you can get risky by going into a market you don't know. You think something's a deal, but that's because that house is stigmatized, or the trains run through the back, or the airplanes fly overhead, or the neighbors are all drug addicts. And you know your city really well. So trying to pick what's a nice neighborhood or whatever in your city is a lot easier. So I try to coach people to stay with what they know to start, and then not make it too complicated on the first one. And if we do a first perfect deal, we should be able to do our second deal pretty quick. This is my point to people, right? So if we're doing them right, we should be able to roll one deal into the next. No more of your money going into this. Once we do it once, you should be able to keep going. So the perfect deal means you bought it under market value, you've improved it, then potentially you put tenants in it at high market rents. So now you're adding the cash flow component to this. And then once you've done all that, you go back to a different lender and you say, look at this beautiful property I already own. Would you like it in your portfolio, dear lender? And they say yes. Because they don't say yes when you try to buy it, strangely. But once you own it, they love you. And then they give you most of your original money back because you forced the appreciation, right? And this is happening anyways. Like if you just sit in your primary residence, you could probably do this right now if you haven't refinanced your house in like 5 years. The market's appreciated it. But if we can force it right at the beginning through our renovation, then we can get that turnover to happen instantly instead of have to wait 5 or 6 years for the market to do it. And people will call this the BRRRR strategy, like buy, rent, refinance, buy, renovate, rent, refinance, repeat, BRRRR. And it sounds really sexy. Like it's really hard to find a perfect one. I'll tell you that much. If you find one, slam dunk. But if not, you're still accelerating. I don't have to wait 5 years to get my next deal. So I just have to wait 1 year or 2 years, right? And for example, like I did this move, pulled the money out of my house to get my cottage, pulled the house money out of the cottage to get the second cottage, right? And so on and so forth. So it's not like you got to go work and save up another $50,000 or $100,000. Once you get this going, you use the real estate portfolio to keep growing the real estate portfolio. You can actually lower your income needs at home.
So how do you make that call on what you're going to keep in the portfolio and what you're going to flip?
So generally, once we identify an opportunity, we're going to declare so let me back up a sec. For the average person, they're going after a specific thing. Our team is well funded and we're very creative and we like challenges. So if we find something with instant equity, we'll vet it. It wouldn't be my strategy for other people because you're probably only can do one project at a time. But like I said, we're trying to do like 8 or 9 development projects at a time, hold on to lots of stuff. So we'll look at almost anything with instant equity. Once it passes that test, then I have to ask myself, what is the best plan of action? And would you be surprised, Mike, if I told you I just analyze it every way and then pick, right? I say, okay, what if we did a quick flip? What if we did a big flip? What if we turned this into a duplex and kept it? What if I just staged it and sold it as is because the market was hot? So instead of, I don't try to guess, I run it all out on a spreadsheet. And then that's typically my job on the partnership too, is to bring those numbers back and say, hey guys, I know this seems like a fun project. Like honestly, we just did one where I was like, after I ran it, the quick flip didn't make sense. The big flip didn't make sense. Turning it into a duplex didn't make sense. What made sense was just throw it back on the market because we bought it, market's inflated by like $100,000 and we resold it. We didn't do any work to it. So that's typically the decision process for us. For most people, I would suggest that you want to be in the game of ownership. You know, flipping is fun. You get a short-term hit, but you also get a tax bill, right? But at the end of it, if you just go and take that wins from flipping you just have created yourself a new job. That's not really an investment. You're just a contractor now, right? Mm-hmm. So some of your real estate you have to plan on keeping, whether it's you're using the flip to then buy the asset you want, like the cash, or this is another one of my little secrets, is if you know what you want in your whole portfolio and then you flip it to yourself, right? Buy it in junky condition, vacant, create it. We like taking a bungalow and turning it into a duplex. And we did that. We didn't buy it from somebody else like that. And we put the first tenants in, because when you flip it to yourself, there's no taxes, right? If you sell it, you gotta realize your gain. So if you're flipping it to yourself or you're refinancing and keeping it, you can avoid all the costs of sale and all the costs of the tax implication on all that. And so that's my favorite strategy, is to pick what you want in your portfolio and then go buy it in horrible condition and create it and leave it in there. That being said, and I'll just add with partnerships, one of the things that actually does for our team decide, we don't like to hold with other people, right? And I advise everybody on this because one of the major ways you could lose in real estate investment is being forced to sell it in an unfavorable time, right? You and I both know if you're not forced to sell in a single year, it's almost impossible to lose historically on real estate over a 5-year window, say. Especially you start to go to 10 and your returns are starting to get pretty guaranteed. But if you and I, Mike, partnered on something with an intention to hold it, because we're just, we have a beer and we're like, let's hold the property forever. And then a year from now, you decide you want to retire and you want to go travel the Caribbean and you say, I want out of this deal. What can I do? I either have to buy you out of the house or we have to both sell it. I don't have a lot of recourse. So I've lost all my power as the investor. So that principle one is I like to hold the people I'm going to ride and die with, right? And then flips, though, because they're nice and short. They're like 4, 6, 8-month, 12-month projects, depending on what we're doing. Those, I love partnerships. So typically that's one of our things too. If we have partners in on it or somebody else brought us the deal and it's going to be a partnership, we almost always think of it as a short-term play, because it can get really messy, like holding properties with people that you don't have perfectly aligned, timelines and financial goals with.
So you're coaching a lot of people on this now, Jeff. I know you've got a webinar coming up next week, and we'll put some information up at the end of this for that as
Thanks.
Well. But if someone comes to you, Jeff, and says, "Hey, like I've been in my house for 5 years. I'm really interested in getting started with this, but I've got $5,000 in my savings account and I just don't know how to get started. Can I do it?" What's the first step for the average person to, figure out if this is possible for them?
It's the same step for everybody, because it's figure your money out, right? And that's not, and we'll go through that in a second to say, like, even if the answer is no, that doesn't mean stop. That means get more creative, right? But without knowing your capital and also your ability to qualify for credit, you need those two things. Otherwise, real estate gets really expensive, really fast, right? So let's take, for example, like you said, the person who's owned the house for a bunch of years isn't really a big saver, but guess what? Congratulations. The government of Canada has given you a huge bank account in your house. Housing prices have gone way up. Now you would have to go and refinance that house to get that money out. But one thing that usually scares people that aren't investors yet is we've grown up in a generation where we were told to pay our house off, right? So that you could retire mortgage free. That was like really basic financial advice given to us, right? And given to our parents. But that kind of thinking, when I say to somebody, go refinance your house, they feel like, oh my God, you're setting me back 10 years, right? I've been working so hard to get this mortgage down. Why do you want me to increase it? And the key thing to remember is we're not taking it off of your balance sheet, right? A lot of people weren't taught very basic personal finance. So they think of the whole world as income and expense, income and expense, income and expense. And they don't really think about assets and liabilities, this whole other separate document, right? So your personal residence, it's hard to feel like that because you have this dream of paying it down. But one thing I do is I run this scenario of showing how you could actually have your whole house paid off in under like 5 to 7 years if you bought another house today. Or how, like I'm saying, I'm taking pilot license right now. I plan on buying my own airplane, but I'm buying a house to hold, to sell later, to buy the airplane. I'm not going to go make money as a paycheck. Planes are too expensive. You can't do that, right? So it's this thought of, can we take that money out? Then we take that and we use that for a down payment. Now you've got 2 assets, right? And we didn't move because you didn't take that money and spend it. You put it in another house. You still own it. So it's teaching people how to play this little shell game on their balance sheet. Now, if you go to your bank and they say no, like you don't earn enough income to hold 2 houses, or there's not enough room to refinance, then we got to go down the steps. Maybe you got to go to a B lender. Maybe you got to find your uncle who's got a lot of money and wants to partner with you on a couple deals. But my favorite thing too is this idea of if you learn how to do a bit of development work, plus you also learn how to be a landlord a little bit. And I'll say there is work. Late night seminars, I want to tell you this stuff's all easy. It's not. There's work. But what I want to show people on these charts is like, hey, if that made $2 more million, 10 years from now, would it be worth learning a couple things? Would it be worth like having a couple sessions? Would it be worth getting your hands dirty a bit to make an extra $2 million? I don't know if you have another way to do that. So I try to not sugarcoat it and let people think it's just super easy. It's not. It's a big, complicated thing. That's why nobody's doing it. But if you put the work in, it's not risky once you know what you're doing. And you can really change the course of action. So the first thing most people I would ask, say you're looking at refining, right? Whether it's through a HELOC or a full refinance, pulling that capital out and using that capital to acquire another asset as a down payment with another loan, right? If you qualify for that, you should do it. If you don't, then we got to get more creative.
So you just brought up the word tenant a minute ago. So I know speaking with with a lot of my clients, when it comes to residential real estate investment, there's some fear around having to actually manage tenants. So how do you do it? Like, because I know there's more than one option. Just because you own a house and you have a tenant doesn't mean you have to be there banging on the door to collect the check. There are other options. So what might you advise someone that had some reservations around managing tenants?
For sure. I mean, I think being your own landlord is a way that you can increase the margins on a deal, right? But we shouldn't buy a deal that doesn't afford us property management included. You know what I mean? So it's the same as if I'm flipping a house too. Like I'm a pretty handy guy. I could probably do a lot of the work to flip a house. Like I'll do renovations if I need, but I'm not buying a project that only works if I put all the elbow grease in, right? That's a way I gain extra profit. So I try to remember, again, this comes back to this thinking that there's a right answer to any of these questions. So that's what gets everyone caught up. And they'll be like, well, what about tenants? And I'm like, well, get property management. They'll be like, well, doesn't that cost a lot? I'm like, well, which do you want? Right? Like which answer? So it's about the investor too. Like, so for our team, when we typically create a new unit, we'll usually handle the first tenancy. We're realtors. We can throw it on the market. We can vet tenants. That doesn't scare us, but we don't like getting all the complaint calls or the repair calls. So once we've got it tenanted and we know it's in our portfolio, we usually move it to property management then. Our short-term rentals that we're lighting up in Tobermory this year, we're going 100% hands off. We're vetting a couple companies right now. We'll just get a report once a month. We won't even know the names of the tenants staying there. My personal second cottage, I'm going to be super hands-on. I want to make it a fun, unique experience. Hopefully even come over and say hi to the people as they check in, right? So the answer is there for everybody. It's like, don't let a silly question like that stop you from making $1 million decision, right? Yeah. And it did to me. Like I had my real estate license. Like you said, we've gone back a long time, right? I didn't start any of this for myself till just like 3 years ago. And I knew how to do it all. And the biggest thing, I swear, was this idea of I'm going to get called in the night to fix someone's toilet. That stopped me. It probably prevented me from earning millions of dollars. You know what I mean? Yeah. That thought.
Yeah. I mean, I can even say from personal experience, because it has been a barrier to me investing personally on it. But I think it's the flaw in the thinking of you're looking at it from the, okay, well, I'm making $150 of cash flow a month on this investment. It's not worth $150 a month of headache to manage a bad tenant, right? But I think it's looking at all of these things with the broader picture. Well, it's not $150 a month. It's that cash flow being a bonus, and here's all the equity I'm building. So is having a pain in the ass tenant worth $500,000 over the next 10 years? Yeah, probably.
And when we think again as an analyst, right, Mike, we're like, the average price of a home is currently rising faster than the people in the house earn it. Right. And that's the thing we got to think about. Until that changes, I would rather own a house and get 2 calls a year from a tenant than get a whole nother full-time job. Right. Who has time for that? And so that's that thinking too. You're right. It is about the cash flow. People get so caught up about, oh, what's the point? This only makes me $100 a month. And I always say, what do you need $100 a month for? You look like you're doing fine. You got a car, you got a house. What is $100 doing for you? We're talking about, let me run this on a spreadsheet for 10 years. And the human brain is really poor at multiplication. It's even worse at exponents. And compound interest is an exponent calculation, right? So rolling those gains up, our brain does not think like that. It only thinks like in straight lines mathematically. So you have to actually put it on a spreadsheet and be like, this is what it looks like. And the math is right. And oh my God, this is worth it, but it feels hard when the return. Most of us need money. Like it's more fun to get a hit today, right? Do a flip and get 20 grand, or buy a house and you've got an extra $300 a month coming in. But this is about doing your future self a favor, or your kids even, which is the cool thing. Like if we want to get into that, is like the lifelong wealth that can be built through this type of activity.
Yeah, I think one of the biggest things is breaking out of the barriers of our generation and how our parents taught us, like you touched on. I mean, I can say, my dad was a chartered accountant, and, I used to always bring any investment that I was thinking of to my dad, right? But, he was still of the generation where, he couldn't get his head around, like, if it didn't cash flow over 6%, you're out of your mind. Like, why would you do that, right? But, he grew up in an era of, mortgages. I think his first mortgage was 18%. And even though, there's a lot of talk on where interest rates are going, and for sure with inflation, they're going to go up. But I don't think our economy is ever going to return to mortgages at that kind of rate. Like it's just not feasible with how our world works anymore. Right. So
it's not even set up that way. Like that, all of that happened before any of, like, the Bank of Canada mandates have only been in place since the early 90s, right? To control inflation and control interest rates. Like our parents grew up in the Wild West financially compared to us. And there was much fewer people with wealth. We forget how much has changed in generations in our country, but to own a second property in our parents' generation was pretty highfalutin stuff, right? Or you had some junky cabin way up north, like in the woods or something. But to be a landlord is kind of a new thing. This can be for everybody, and that's why you're seeing prices rising. They're saying like up to 30% of the transactions are by investors, but a lot of it is using you and me. It's not some big hedge fund, right? It's just that people are realizing, hey, I could buy that house. And I tell my kids all the time, my kids are 8 and 10. And one of the things I really try to pepper into them as we drive around is that every single piece of land is owned by somebody, right? That's what we have to remember. Sure, there's some crown land left, but it's usually undeveloped. But everything you look at, every house, every plaza, every high rise, somebody or some group of buddies owns that. Why not us, right? Usually the people that own all that real estate, they don't got to go to work all day either for their whole life till 65, right? This is what we've seen. It's one of the safest ways to generate wealth, one of the most proven, and our entire economy is based on real assets. Like, not to go too deep, but you know why the bank, like the Queen of England, is still rich and still in charge? It's because they own like 10% of all land in England, and the government rents it back to them for hundreds of millions of years. They set all that up when they like set up the democracy. So they're some of the biggest landlords on planet Earth.
Yeah.
You know what I mean?
Wow.
And that's how they stay in power.
I mean, it's rare that you meet anyone with any large amount of wealth that hasn't made it in real estate, right? I mean, even if you're making $1 million a year at your job, I mean, you're keeping 46 cents on the dollar, right? So
and you probably have $1 million lifestyle too, right?
Yeah.
So saving is really hard for all of us. To have money left over at the end of the month in 2022, no matter what your income level, nobody wants to. I teach a little bit of a personal finance course, especially to my realtors, and I'm like, look, where do you want to put your effort here? You can either decide to make more income. That's hard, right? You got to go back to school. If you're a salesperson, you got to grind and get a coach. Or you could get a second job, I guess. You can reduce your expenses. Nobody wants to be told to do that. That's not fun. Downgrade your lifestyle, Mike. Sell some stuff. Don't go on a vacation. Or we can look at the other column. I'm going to go play this game and teach myself how to be an investor. And that game's fun. It's really hard to earn more income. It's horrible to try to cut your expenses. But learning how to increase your assets is a fun game. And once someone teaches it to you, you don't want to really play any other game.
So that's a good segue, Jeff. I don't want to keep you too much longer here, but
no worries.
The current market conditions that we're facing right now, super, super low inventory everywhere, I'm sure in Brantford as well. Mm-hmm. So I'm interested to hear, whether or not your strategy in terms of growing your portfolio has shifted to accommodate what's going on in the market. Like, I mean, we've got a number of buyers that are like, hands up in the air, we're out until things soften. You're buying things purely for investment. Are you still acquiring properties in a seller's market?
We're trying. Other crazy buyers are beating us a lot of the time. But this happens. Like, this is our second cycle through this, because it happened last year too. Right now is the hardest time, right? Because we're at absolute low inventory. So we're always trying to predict, okay, when are things going to be better, or what's my strategy right now? Right now, it's incredibly hard to buy, right? In a shifted market, it's really easy to buy. Like all those "we buy houses" flyers going around, and you can buy a house off market and all that. And nobody's competing, or there's stale listings. But then you reno it and try to sell it, or your appreciation's not going to be that good in that market either, right? So every market has an upside and a downside. So right now it's incredibly easy to unload something. Rents are skyrocketing too. So any vacancy is great. Like in a slow market, you're like, my tenant's leaving. Right now you're like, thank God my tenant's leaving. I get to re-rent this at new rents, right? And money is still very cheap. So this is the thing people don't understand is one of my, I'll actually give this credit to a commercial realtor I worked with. And he helped me understand, because he wasn't from Brantford and he came down to our city from a slightly bigger city. And I was trying to explain to him, like, hey, this is what's going on. He saw the potential in our town for commercial investment downtown and everything. And he goes, Jeff, the reason that nobody in Brantford is going to do any of these deals is because they remember what they could have bought this house for, or could have bought this street corner for. And that little thought will break their brain right into the grave. They will not take any action. And that's what the big answer to your question there is, you got to be looking ahead at the next market. When a good time to get into this market was 2.5 years ago. Right.
Yep.
And we were lucky, and other people were lucky. And this type of market shows you the benefit of holding assets, not just being a flipper or whatever. But then we're ready for the next one. I think the inventory softens up a bit in the spring. Prices aren't coming down. Don't get me wrong. That's not a pricing crash. It just means there'll be more inventory. Buyers will calm down a little bit, and there'll actually be some choice. There'll be a few sellers that don't sell in 5 days, and I might be able to go buy something. But I'll give you one short story to explain. We bought a house in this market, and I won't even say the address because we almost feel guilty about it. But it was listed on the open market with one of my team members, an active realtor. It was a third-party client, just a residential client. Sell my house, please, right? She went out, did a full CMA for these people, went over the marketing strategy, but like clients do, they picked their price, they picked how to prepare their home, right? We can only influence them so much. And then because their home was kind of very cluttered, we'll call it borderline hoarder, right? Without being decluttered at all. And instead of doing what the market was telling them to do, which was price it under by like $100,000, they put it where they wanted it because they're more conservative. So they didn't take the realtor's advice on 2 points knowingly, right? So offer day comes and goes, and nobody bought this house in this crazy market. So the realtor calls and says, hey, the client's like freaking now because every house around them selling for multiple offers, and we just were on the market for a week and it's crickets. And I said, well, how much do they want for it? They want full ask. Done. We bought it, right? Now, we got lucky that the market went bananas over the winter, but even if we didn't, we had it priced to be a flip, right? We were going to flip it. But we just waited. By the time we closed and December came and went, we just threw it up on the market. And get this, Mike, we emptied the house. We did not renovate it. We just emptied it and put fake staging furniture in it. We put it back on the market. And we had a lineup of bully offers, preemptive offers, and we ended up selling it for $170,000 more than we just bought it for because we emptied it, right? And put different furniture in it. That was a $3,000 rental furniture, right?
Yeah.
Now, to me, that again is like, that was in plain sight. Anybody could have bought that house. That lady could have stayed in that house. But because we're the investors, we understand the market conditions coming in 2 months, coming in 3 months, not 3 years. I can't tell you what's happening in 3 years, but I'm pretty good at telling you what's going to happen in the next 60 days. And so that type of, like, it's that attitude of it's crazy. No, it's like, where's my angle?
Yeah.
My old football coach used to say, if this was easy, everybody be doing it, Mike.
Yeah.
Right.
Well,
you got to realize it's hard. It's hard. Right.
Yeah. Well, I mean, as much as people don't want to hear it, the reality is it's probably the cheapest it's ever going to be to buy real estate right now. Right. Like, yeah, really. I mean,
I joke with my wife about gas like that. I'm like, gas is so cheap, babe. I just leave the car running all night to keep it warm. This is the cheapest gas is ever going to be for the rest of history. I don't actually do that.
Well, that's awesome, Jeff. thank you so much for sharing all your insight on this. It's really quite eye-opening to see how really easy it is once you understand what you're doing to build wealth this way and to build generational wealth, right? So, and I think the biggest hurdle is breaking out of the mindset, the traditional mindset. And what's it, Bank of Nova Scotia? You're richer than you think. It's I think people really need to understand, how much money they may have available to them within the home that they already own to get started with this, especially with 20 to 30% market appreciation a year over the last couple of years. I mean, you would have had to buy really poorly to not have built a ton of equity over the last 2 years, right?
Yeah, and they're doing the refinances like really easily right now, right? That might change too as the rates change and stuff. But I think for me, Mike, you're right. Like we talked a lot of stuff at a high level, and what I've been realizing, and that's this webinar I'm doing next week. Yeah, next Wednesday. What I'm going to do in it is very basically, like, I could talk up here all day, and I like to, like, let's talk big strategies, let's talk cap rates. But what I realized is the average person that you're trying to get through too on this call is they need to see that it's worth it, right? And what about being a landlord? What's the cash flow? And those are all symptoms of it doesn't feel worth it, right? So that's why I'm in this seminar. I'm running 3 scenarios just to show people. I'm not saying you got to do any of these, but I was like, here's how you can use one more house to pay your house off in half the time. Here's how you can use one house to retire 10 years earlier. Here's how you can use one house to send your kids to school. Because those are like right there questions that people are worried about. And by showing you how to use a house to do it, instead of using your own hard-earned money at the job you hate all day and putting in overtime and saving and not going on a vacation, but to use a house to do it. And I think what I've realized after having so many of these conversations, if I can get someone to break through and say it's worth it, then they're willing to go put in the work, right? Because it is work. If you just want it to be hands off, then go put your money in a REIT fund on the Toronto Stock Exchange. But if you want the returns that we're talking about, if you want to own the stuff, you are going to have to learn stuff. But if you're a fully functioning adult with a job, you can learn real estate investing. It's like 3 equations, right? And a little bit of local market knowledge. And you build a team around you.
I think that's one of the differences too, right? Like, I throw my money into the stock market. I mean, I have no local knowledge of that, right? Like, I'm at the mercy of the guy that manages my investments, right? But if you live in a community, even if you're not a real estate agent, I mean, you're an expert to some degree on real estate. Maybe not values, but the best neighborhoods, the best places to go, right? Like, you know more about picking a winner than you might think, right? So
for sure, like when the cottage across the street from me came up for sale, in a blink of an eye, I bought it because I knew it was undervalued at list price, right? And I only knew that because I live on the street. I wouldn't know that on somebody else's lake, right? And I agree with you. So you're richer than you think, and you're already smarter than you think, is what I try to teach people. Is that this isn't like complicated calculus. This is like A minus B minus C minus D equals profit. It's like linear arithmetic, but you just have to learn how to do it and understand it. And then the biggest thing is the leverage. I wanted to get this in because we didn't talk about it, but the thinking of the 5X, right? That's the thing I was showing people. That's one thing everyone can understand, that if you own something and it goes up, but if I only had to pay 20% of it, I only paid a fifth of it, right? 20% is a fifth of the whole price. So now when that asset goes up in value, I'm getting a 5X leverage on that.
Yeah.
On a primary residence, it's 20. If you're only putting 5% down on your first house, you're getting a 20X leverage on that investment when it goes up. And it's almost, I don't want to say guaranteed, but our economy is baked in to have real estate prices rise. Inflation is built into our market. Homeownership is very valued in Canadian society, probably more than anywhere in the world. Canadians like homeownership more than other countries like homeownership. And that's not going anywhere for at least 10 years. Like, this problem and the conditions that have been created right now took decades to happen. One government decision or one rate change isn't turning the market 180. It's taken a long time to get here. I also just read that Canada has the lowest number of homes per capita of any of the G7 countries.
Yeah, we had,
and that Go ahead. Yeah.
We had Phil Soper on from Royal LePage last week, and that's what we touched on. So we've got
so that explains, right, why it's inflating here faster. We're not building enough homes for how many people live in Canada. It's just, and it's one last thing. I get all my quotes out today, but Mike, real estate is literally one of the only assets you can invest in that is a basic human need. Can you invest in air or water, right, or protection? Not really, but everyone needs a house. And so unless we're going to, especially Canada with winter, right, you can't just go live in some compound out in the desert. So everyone has to have a house, whether they pay a landlord or whether they own their own mortgage. So which one of those do you want to be, right? Why not be the guy that owns other people's houses too? If you already own your first one, you might as well get a second one. So my biggest piece of advice is always buy your first home as young as you can, and then get your next home as young as you can. And just keep doing that until the pile's big enough, right? But if people ask me, when should I get my next house? Now. I don't care what the market's like. Because once you put it in the chart and start running it, it's so much more advantageous to do it now than wait 5 years for the market to improve or something. You've lost 5 years of your life, and you're 5 years closer to retirement. So I try not to worry about the micro. I try to think about the macro on everything we do.
Well, it's been awesome talking to you, Jeff. As always, I'm always super excited about any topic that you talk about. So I think I'm going to leave this and go to the MLS and start shopping for my next investment property. But I really appreciate you sharing all these nuggets. And as I say, we will add to the notes about your investment class. And without question, if you're up for it, we're going to get something on the books for our clients and friends, so we can learn about this in more detail from you.
Nice. Yeah, I love talking about this and teaching about it because I'm living it too, right? Like it's made such a change in my lifestyle with my family and what my kids are going to have when they get older that I'm not selling anything really. Like I don't have a product for anybody to buy. I'm just passionate to show other people this way because it's like it's real. It's not a late night infomercial. It's every man can do it. Every woman has the skills to do this, and you should take advantage of it as young as possible. Thanks for having me on, Mike. I really appreciate this.
No, thanks so much, Jeff. We'll talk to you soon.
Cheers.